Good evening, Business 330 students. This is Professor Hasse. It's our week number 2 update video, part 2. And why do I say part 2? As I'm traveling this week, I'm back in the Midwest, and the Wi-Fi here, for lack of a better word, sucks. And I did a video earlier today, Friday, November 4th, and spent a lot of time on it, and it did not, it crashed. Just found out about it crashing, and now I'm doing a new one. It's a little bit later in the evening here in the Midwest, but wanted to get this to you to help you with your assignment number 1 due this Sunday at midnight. But again, remember, even though it's due Sunday at midnight, if you need extra time, need an extra day, need an extra couple days, be sure just to let me know. It will not affect your grade. Just send me an email and say, Mr. Hasse, I'd like some extra time. Here's when I'm planning on posting it. And that is fine. So just remember that as you're doing your work, this first assignment of our class this weekend. I want to talk a little bit about chapter 3 and chapter 4, finish up our beginning of our discussion that we did on Monday. I'm going to run through this rather quickly due to the internet speed of where I'm at. Hopefully it will not crash again, and make sure I can get this video posted to this evening on Friday. So let's take a look at, first of all, here's our Blackboard. We have week number 2, that's our agenda. And I want you to pay particular attention to the lecture notes, the financial statement analysis PDF, which gives us a page out of the textbook with all the key financial analytical data and calculations, and of which you're going to have to use in your assignment, and a spreadsheet that we're going to be doing in just a few moments. So Fall 2, 2022, Week 2 in-class review spreadsheet. And here is that spreadsheet now. Okay, remember we talked about earlier this week in our beginning of the week video that we're looking at the financial statements and the financial statement analysis of companies. What happened and what does it tell us about the future is key to financial management of corporate finance. And one of the indicators or one of the practices you're doing with the assignment, that's what the assignments are in this class. They're basically sophisticated homework where I ask you to go over definitions and review calculations and try out theories and real world expertise of some of the topics of our first 2 weeks of our class. And some of the topics this week is to take one company from your portfolio, which you all have completed, and make sure you go to that in your assignment and look up the earnings per share and the key financial analytical ratios and percentages, which we're going to go over this evening. Also remember that this assignment is a practice for the examinations and for papers in this class later on. Also, I want to point out, as far as grades are concerned, if you have any open items in your portfolio from week number 1 and you don't see a grade for that work, please clean that up so I can get that grade posted and corrected for you. Also, if you have not scheduled an appointment with me for next Monday, November 7th, as a one-on-one professor interview, please do so this weekend, because remember that is also for a grade, 5 percentage points of your grade. If you don't sign up and don't see me next Monday, that'll be a 0 in your grade center. So just please make an appointment on the time scheduled. If it does not fit into your schedule, please let me know, and we'll find a date and time when you and I can get together. Okay, now on Monday, we talked about the balance sheet and the income statement of a company and what they tell us. We also took a look at the cash flow statement, which is a way of looking at where the cash came from out of our business. Cash flow from operations, net income, depreciation, the borrowing of short-term money coming in, cash flow going out in the form of inventory balances high and accounts receivable, cash going out in the form of paying off debt, cash and dividends, cash coming in the form of common stock being issued, In this case, example of Reggie Dunlop Incorporated, they issued 150,000 more shares of stock in 2021. And then cash going out of short-term investments and the purchase of fixed assets. The combination of all those equals $6,718, and that equals the total delta of cash and cash equivalents between the 2 years of $6,718. So those are the three main financial statements of a company. But what we like to do is financial statement analysis. In other words, taking a look at trends in the business, comparing our business to the industry, our competitors. This tells us also an awful lot about our business and are we operating it efficiently, and also to plan in the future. The 6 key ratios or information we're looking at for our course: current ratio, debt ratio, profit margin on sales, return on total assets, price earnings ratio, and earnings per share. All of these are talked about in chapter 4, except earnings per share. We're doing that on our own, separate from your reading in chapter 4. Now, where to find this information? Well, to find financial statements, you can go to Yahoo Finance, you can go to the company's website, you can just even Google the information. So current ratio is a liquidity ratio. It's the current assets of the company divided by the current liabilities. It tells us the relationship between short-term funds, assets, and short-term liabilities. And as you can see in this company, it's gone up. If you take current assets and current liabilities in 2001, let's go to the balance sheet. Current assets are $2,680,000. Current liabilities are $1,039,000. If you divide those, you get 2.58. That is very high. Notice the industry average is 1.25. And this all goes back to those high receivables and high inventory balances we talked about the other day. This company needs to clean up those receivables and inventory. Their current ratio is way too high. The correct current ratio should be anywhere between 1.2 and 1.7 for a company. 2.58 is not good. So it tells us of some problems with the company. The next ratio or instrument is called debt ratio. It's the debt management of the company, the relationship of total debt to the assets of the company. Very important number. In this case, the total debt is $1,539,000. Divide that into the asset base of $3,516,000. You get a debt ratio of roughly 44% for this business. Notice the industry average is 60%. But also notice that the company's debt ratio in the prior year was almost 81%. And why did that go down dramatically? Well, remember in the cash flow statement, we saw that this company paid $920,000 of their debt by the raising of capital in common stock. Not a smart way of doing business, though, because issuance of common stock is the most expensive form of financing. You got to pay stockbrokers, lawyers, attorneys, very expensive. And then you have to meet the expectations of the investors to provide returns to make that stock price go up. But this company decided to issue stock to pay back their debt. Usually a company issues stock to purchase assets, revenue producing accounts or assets to produce growth. This company didn't do that, and that could pose a problem down the road. The profit margin on sales is the relationship of net income to the sales of the company. So if I take the net income for 2021 is $290, $253, $584, and divide that into the sales of the company, what percent is that? Well, it's about 3.6%. Again, down from the industry average of 5.25. This company has some negative returns or negative numbers in relationship to the industry that they're in. Notice in the prior year when they lost money, they had a negative profit margin on sales, but that makes it look a little better for 2021, but still they are below the industry average. The next number is the return on total assets, which is the relationship of net income to the asset base of the company. So it's 2,538,54, the net income, divided into the asset base of the company, 3,516. What percentage is that? About 7.2%. Again, below the industry average. So the company is just not quite making the money that they need in cash flow and profit to keep up with the industry and their competitors. That could pose a problem. Now let's just skip over the price earnings ratio and look at the earnings per share. The earnings per share is another way of showing net income of a company. And the earnings per share is the net income of the business divided by the outstanding shares of common stock. So net income, going to the income statement, 253,584, and I divide that into the number of shares of stock outstanding at the end of the year, $250,000, 250,000 shares. So I take that relationship of net income over outstanding shares, and it's $1.01. In other words, the company, for every share of stock, made a profit of $1.01. Last year, it was negative because they lost money and they had the lower amount of shares. But this is a common way that many businesses show net income. Instead of showing big, huge numbers, be it positive or negative, with a lot of zeros, it's easier to show your net income by a per share balance. That's why you can go into any company that's traded publicly and go to Google and just type in earnings per share for Ford Motor Company. It'll give you the earnings per share for the recent period of time that you're looking for. That's an easy way of getting it. Calculating it can be a little bit of a challenge because finding the correct amount of outstanding shares of stock for major corporations is difficult because there's hundreds of millions of shares of stock. Makes the calculation a little challenge. So you can look this number up pretty easy on the internet. Well, once we have earnings per share, then we can determine the price earnings ratio. Price earnings ratio is the relationship of earnings per share to the stock price. So for example, our earnings per share is $1.01 for 2021. If we go to our income, to our financial statements, look at the closing stock price of $12.17, the relationship of that is 12.05. In other words, the stock price in the market, $12.17, in relationship to the earnings per share is a little bit over 12 times greater. Now, what does that mean? Well, it means that the company's stock price in the market, 12 bucks, is about right for what the earnings they're earning. Now, if you get a company like Tesla, who has a PE ratio of 310, that tends to say that the stock is overvalued in the market to the earnings that that stock is generating, which in most cases means stay away from the stock. But the reason why people buy Tesla stock is not because of the earnings and the profit, it's because of the future capability that the company may have of obtaining profits due to their hold on the market and technology of electric automobiles. So people are buying for the future. That's why they're buying the stock. But as far as liquidity as profits are concerned, it has a high PE ratio. So those are the numbers that are important to know for the assignment, for the work with your portfolio, and for future examination and papers. These 6 you need to be familiar with, and that's why we have this spreadsheet in week number 2. And they will help you find and define. Remember, you have to define them in assignment number 1. So I'm going to close right now our week 2 update video and post it tonight, Friday, before I get shut down by the Wi-Fi here, wherever I'm at. And I'll look forward to all of you to next Monday and beginning week 3. Again, if you need an extension on your assignment, please let me know. And again, if you need help over the weekend or questions asked, please feel free to send me a text like Raymond does, or send me an email, or post to the discussion forum. Any way that I can help you over the weekend, let me know. All right, everybody, have a great weekend, and we'll see you next time. Adios.